lower your tax bill, the more money you have left from your income to invest towards your financial future. This is what tax saving is all about, reducing your tax liability as much as legally possible. A lot of things are uncertain in the world, but tax isn't one of them. Whether you're employed, own a business, or work as a contractor or freelancer, you must file your tax returns every year. However, the law doesn't actually tell you how much you legally should pay. Unfortunately, if you don't have a tax saving plan, you're probably shouldering the biggest tax burden. That's because smart tax saving strategies can massively reduce your taxable income and tax bill. But as someone with no professional tax experience, where do you even begin? In today's video, we highlight the basics of tax planning for beginners, as well as arm you with the smart tax saving strategies to keep more money in your pocket. So stick to the end as we also highlight some common problems beginners face when trying to save taxes and how to overcome them. Like the video yet? Let's get started. What do you need before you can start implementing tax saving strategies? There are a couple of things first that you need. Well, for one, familiarize yourself with the federal and state tax laws. Saying the U.S. tax code is extensive is an understatement. Now, you don't have to read through everything. However, you want to familiarize yourself with tax laws that affect you. Understand your financial records. If you're not already keeping thorough and highly accurate financial records, especially if you own a small business or have a side gig, then you should definitely start now. When you file your tax returns, you'll need good records to determine your income, expenses, and even more importantly, your deductibles. Get an accountant if you can, even though it's not a must to have one at all times. A certified accountant or other tax professional can really help you understand how to implement some tax saving strategies. So now you're familiar with important tax laws as well as your income and expenses. How can you now save on taxes? Here are 6 smart tax saving strategies, starting out with number 1, maxing out your retirement accounts. If you earn income every month, you should be contributing a portion of that money to your retirement. And the earlier you start, the more you can save and the more you will be once you retire. But beyond that, contributing towards retirement can actually save you some of your hard-earned dollars. That's because retirement accounts come with tax strategies. Tax strategies as well as tax advantages. However, these advantages vary with the type of retirement account you do choose. Basically, there are 3 types of tax advantage retirement accounts, starting with your 401ks or 403bs. With these plans, contributions are typically tax deductible, which means you contribute from your gross income before it's taxed. So this effectively reduces your tax liability for the entire year. Also, you have your traditional IRA. This account works with much like a 401k in terms of tax. However, 401ks are sponsored by employers, while traditional IRA needs you to open it yourself. A 401k may also come with an employer match, which is not available for a traditional IRA. In both, however, you pay income taxes only when you start withdrawing your savings in retirement. And also lastly, we have Roth IRAs. Unlike the first 2 options, which are tax deferred, Roth IRA is considered tax free. This basically means you won't save on taxes now, but you will be able to withdraw tax free once you retire. The key is to contribute as much as possible to your retirement accounts to reduce your tax bill. However, keep in mind that there are contribution limits for each. As of 2024, the 401k contributions limit is $23,000 for employees or $69,000 for plans with an employee match. For traditional IRA and Roth IRA, the limit is $7,000. 2 is contribute to HSA and FSA accounts. If you have a high deductible health plan, otherwise known as HDHP, you can contribute to your health savings account and enjoy 3 incredible tax benefits: tax deductible contributions, tax-free growth, and more importantly, tax-free withdrawals for medical expenses. Basically, a health savings account, or simply HSA, is a type of personal savings account that allows you to put money aside for medical costs. A flexible savings account, or FSA, is also a tax deductible medical savings account like a HSA. However, it is offered by employers, as well as employee benefit. Plus, you must use it by the end of the year or you lose it. As of 2024, the FSA contribution limit is $3,200, while the HSA limit is $4,150 for self-only coverage and $8,300 for family coverage. Number 3 is maximize your deductions. So the best way to think about deductions is expenses that lower your taxable income. And when your income goes down, so does your tax. Now let's quickly highlight the most common deductions that you can use to reduce your taxable income legally. Starting with, which everybody should know, is your standard deductions. This is a specific dollar amount that the IRS allows you to deduct from your taxable income. The good news is that the Tax Cuts and Jobs Act of 2017 increased these amounts by nearly double. As of 2024, you can claim up to $14,600 as a single filer, or $29,200 if married and filing jointly in standard deductions. Also, you can do itemized deductions. These are expenses you incurred that the IRS allows you to deduct from your taxable income. They include things like mortgage interest, medical and dental expenses, student loan interest, property taxes, state or local income taxes, charitable donations, etc. Keep in mind that you can't claim standard deductions as well as itemized deductions. The rule of thumb for this is go with whichever is the higher tax deduction. You also have business expenses. If you don't already own a business, you're missing out on huge tax savings. That's because you can deduct all kinds of expenses, including equipment, home office expenses, business travel, and supplies, just to name a few. Number 4 is claim your tax credits. Unlike deductions, which reduce your taxable income, tax credits reduce your tax bill directly. Basically, you deduct this from the tax amount that you owe the government. The most common tax credits include child tax credits available for parents with independence under the age of 17. You also have the earned income tax credit for lower income earners, and educational credits, typically for higher education expenses. Number 5 is harvest your capital losses. Have some of your investments made losses this year? You can recoup some of this money by using your capital losses to offset some of your capital gains. In fact, if losses exceed gains, you can deduct up to $3,000 more from the rest of your taxable income. Number 6 is invest in tax advantaged assets. Beyond retirement accounts, you can also invest in other tax efficient assets. A good example is municipal bonds, which are exempt from federal taxes. That means that the income you earn from them won't be included in your modified adjusted gross income. There are a few tax exempt mutual funds and ETFs that you can use as well. So how do some of these strategies work in person? Let's use the example of James, a tax-paying citizen who earns a gross annual salary of $120,000. Before any deductions, James automatically falls under the 24% income tax bracket, which means his tax bill is $28,800. However, he can max out his 401k by contributing $23,000. This reduces his taxable income to $97,000. Let's say he also has a HSA account with family coverage. This means he can further deduct $8,300, which reduces his total now to $88,700. Lastly, he can claim the maximum standard deduction of $14,600. So his taxable income has decreased to $74,100, and his tax rate has fallen to 22%. This means his tax bill is $16,280, which is a tax savings of over $12,520. Now, let's say James has 2 children aged 12 and 9 who depend on him. He can potentially claim up to $1,600 per child on his 2024 tax bill. This will reduce his taxable income to just $99,320. That said, tax saving isn't just about reducing your bill during tax season, it's about reducing it now. It is also about implementing the best practices in your personal or business finances. So the key is prioritizing tax literacy. In other words, you want to keep yourself up to date with tax laws. For example, various tax codes implemented in 2017 are set to expire in 2025. What will these mean for you or your business? Keep all your receipts. Remember, records can save you money and help you prove your IRS deductions during tax time. Time your business income and payments to work for you. For example, if you make a high income, you can defer some of it to the next tax year to avoid qualifying for higher tax brackets in the current year. What I would suggest is seek personalized tax insight from a professional. Remember, every person's situation is unique and not every strategy may work for you. Now, as a beginner, implementing these tax saving strategies may come with a challenge. So let's quickly look at some common bottlenecks and how to get over them. Changing tax laws. So tax laws are complicated and change quite frequently. So you want to keep yourself up to date and always have an accountant on call to seek clarification whenever it's necessary. Also, eligibility for deductions and credits. Unfortunately, deductions and credits aren't universal. Your income and expenses have to meet specific criteria. That said, familiarizing yourself with tax codes will help you figure out what you can claim and how to maximize such claims. Also, with compliance, in the quest to save as much tax as possible, there is the risk of breaking tax regulations, which can lead to penalties and other legal issues. So it is important to balance between tax planning and compliance so that you don't cross the invisible line. Again, consult with a tax professional in the beginning can help ensure your compliance. We remit a significant part of our earnings to the government as tax. However, with smart tax saving strategies, you can reduce your bill by half or even more. These savings can add up to thousands of dollars that you can invest in building wealth and obtaining financial freedom. The earlier you start, the more money you can keep in your pocket every year, and the more you can actually save in the long run. But as with anything else, practice makes perfect. So learn about these current tax codes and use them to your advantage. Over to you. What are some of the tax saving strategies that have helped you reduce your taxable liability? Comment below. And if you enjoyed the video, like, subscribe, and turn on your notifications because we drop tax related videos like this regularly. Thanks for watching and see you in the next one.